Good evening. My name is Chandler Ryan. I will be joined by Galen Longo, Jake Neely, and Zachary Cagle in presenting our analysis over outreach networks. In this report, we examine outreach networks exploring the possibilities of embarking upon a capital formation through the use of venture capital. Through the utilization of both a venture capital and discounted cash flow model, we can obtain financial data points that will allow us to clearly conclude which path the company should take. Everest Partners, a venture capital firm, has offered to give Outreach Networks $30 million in exchange for a 30% stake in the company. Through our analysis, we have concluded that Philip Perez, the founder and CEO of Outreach Networks, should decline the Everest Partners' current offer for $30 million at 30% stake and instead renegotiate the same investment offer for a 15% stake in the company. I will be followed by Zachary to go over the company's current and projected performance.
Outreach Networks is definitely not your average startup company. It's a wireless internet service provider with diversified global operations that was started with only $50,000. It's got a lean, efficient operational model with less than 100 total employees as of 2011. It experienced explosive growth in its first few years of operation. This is very typical of startups. For example, first-year operations only yielded $9 million in revenues, and that grew to over $63 million in revenues by 2011. Something that's very atypical of a startup company is that this particular company is not currently reliant upon borrowing nor outside investors to finance their operations.
In the current performance, we see an increase from 2009 to 2011. Looking more closely, we see an increase in the year-and-year growth from 144% in 2010 at 22 million to 186% in 2011 at 63 million. Outreach Networks operates in 4 different regions: North America, South America, Europe, Middle East, and Africa, and Asian Pacific. There are some opportunities and challenges we need to take in consideration when evaluating a company that operates globally. Some of the opportunities are demand for wireless internet service providers, emerging economies, and potential growth. For challenges, foreign markets can come with political instability, rules and regulations for operating in different parts of the world. For the current projected performances for Outreach Networks, you see a good performance in 2012 with an expected growth at 124.64%. The growth reduces in 2013 to 54.96%, but then we see it stabilize at 25 to 28% for the next following 5 years. Also, you see for the cash flow, it does steadily increase from 2012 to 2017. This company has no interest as the company has been bootstrapping without borrowing any funds or taking on long-term debt.
Hello folks, this is Galen Longo. I will be covering slides 7 through 10, and we're going to begin with the current business model and the foreign trade area risk factors that the global footprint poses on the entire business model. So Pete Perez effectively captured the demand for wireless internet in several different regions of the world, and each region poses potential challenges in political, economic, and infrastructure, as emerging markets often do. After examining the trade area, it was determined that a majority portion of the operation exists in potential areas prone to business interruption by examining a report that lists economic decline index across the globe by individual country based on a scale of 1 to 10, with 10 being the greatest. We got this information from the globaleconomy.com's report on economic decline index per country around the world. To calculate the probability of failure, we selected 8 countries in each geographic region and calculated an average risk factor percentage, multiplied against a 60 as well as a 75% total failure rate. And we did this with the 60% and the 75% being the ceiling. We then took a weighted average and determined the probability of failure to factor into our DCF model for examination on this subject. So for the basis of our discounted cash flow model, we used the projected free cash flow estimates from 2012 to 2017 by using an assumed weighted average cost of capital of 7.75% and a growth rate of 4.90%, which we got by using US inflation rates and the recommended add-on from the text. Because the actual market return in 2011 was much less than what it is today, we input a market return of 10% and an average peer beta value of 1.5 in order to get close to the current Wall Street Journal prime rate of 8.50%. We felt that it was appropriate as the company did not have any outstanding debt at the end of 2011 and appeared to plan on managing the financing of their growth through short-term financing and reinvestment of their retained earnings. We also made an additional assumption to reflect the likelihood of interest expense based on theoretical debt incurred at the rate of 10% of the company's annual revenues. Likely they would obtain the financing in the form of a line of credit, which is very common for a startup company. Here on slides 9 and 10, we're going to give the examples of our 60% failure rate ceiling as well as our 75% failure rate ceiling and how that differs from the text 50% failure rate as offered by Everest Partners when completing the valuation for the company. So obviously when we completed our calculation model, we used the inputs that we calculated, and it was determined that the equity stake of $30 million based upon the text 50% assumed failure rate would actually be less than the Everest Partners proposal of a 30% stake on the aforementioned investment. So discounted cash calculations based upon the calculated failure rate of the regional economic decline indexes produce a higher stake than the offer, with an estimated 32.9% stake based on the 6% failure rate index and a 31.62% based on the 75% failure rate index. While these failure rates indicate that the offer by Everest Partners is a fair one, it is indeed assumed that there could be a significant interruption in the trade areas. However, this assumption does not take fully into account the management of the company's business strategy that has produced tremendous revenue growth across multiple areas with apparent broad diversification, excluding Asia Pacific. Total value of the firm was estimated to be just over $3.1 billion, and after discounting for potential failure as well as anticipated interest payments, the value stood at just over $1.72 billion per available data. Here on slide 10, once again, it's a calculation of the discounted valuation model, and this is on the 75% failure rate. Highlights of this slide are that the terminal value is actually less, obviously because of the 75% failure rate ceiling as opposed to the 60. That terminal value for the original owner's calculation, that remains the same. But noted that that difference in the equity stake at 50% failure rate and the failure rate at what we calculated at 43.48%, we're looking at a difference of 4.12%. So that's a significant amount of value across the size of that company.
For the VC valuation methods, we have a couple of assumptions for our model, and that would be based on the initial investment of $30 million from Everest Partners. We have the target rate between 40 and 60%. And the owner, Pete Perez, is going to use a PE ratio on the average of APKT and ARUN. These companies are the closest size to ORN's projected future value, so the owner thinks that the PE ratio is more appropriate for our calculations. The mean forward EBIT of 9.4 and average PE ratio of 21.85 were all calculated from the information provided. We use two methods of valuation when looking at the venture capital valuations. We use the average EBITDA and average PE multiples. These are outlined and found in Exhibit 2 that was provided. Both evaluations include a liquidity discount of 30%. Investors value liquidity and would pay more for an asset that is fully liquid, so we must apply this discount to our valuations. Each terminal value is calculated and brought to a post-money valuation using the target rates of 40, 50, and 60%. From there, we can calculate the pre-money valuation by subtracting out the $30 million investment. The post-money valuations at 88 and 99 million under a 60% target rate confirm how Everest could arrive at a $100 million valuation. With target rates around 50% or lower, the value dramatically increases, making Everest's offer much less attractive. We've also calculated the round price of shares from the shares outstanding and using the equity stake to calculate new shares and what that would come out as a price per share. The owner Pete uses a multiple that is a PE ratio between APKT and ARUN. This gave the highest multiple value and ultimately the highest valuation. With a target rate of 40%, the company is valued at $281 million. This is much higher than Pete's initial prediction of $200 million. And even at a 60% target rate, the company is valued at $126 million, which is much lower than Pete's estimate, but still higher than Everest's estimate. The average valuation is around $150 million, with the median of $132 million, which is still well above Everest's $100 million valuation. Pete should negotiate for the best possible deal before providing support for his projections to get Everest more confident in his business so he can lower their discount and target rate and improve the valuation.
Good evening. My name is Chandler Ryan, and I'll be going over the conclusion of our analysis. Philip Perez should not accept the offer from Everest Partners for a 30% stake in Outreach Networks for $30 million in funding. Perez should renegotiate a deal for 15% stake for $30 million in funding, and if Everest Partners do not accept the new offer, Perez and Outreach Networks should continue their operations without venture capital funding. In accordance with our analysis and valuation models, this decision would be best for the long run of Outreach Networks. Philip Perez should negotiate for the best possible deal by providing support for his projections to get Everest Partners more confident in his business so that they can lower their discount and target rate and improve the valuation. He will also need to make a compelling case for using the PE approach due to its high valuation outcome. And once Philip Perez pushes valuation to an acceptable level, he should accept the deal if he feels that Everest Partners is the right long-term partner for his enterprise.